Hello, clients and friends. This is Craig Llewellyn from U.S. Investors International, and it's my pleasure to present our fourth quarter economic review. We believe an informed client is our best client. As you watch this, please keep in mind it is a review of months of October through December of 2025, so the fourth quarter of last year. So 2025 marked the third consecutive year in which equities delivered double-digit returns. The extended bull market was powered largely by three federal rate cuts during the second half of the year, robust AI-driven technology earnings, and broadly positive investor sentiment. During the fourth quarter, investors continued to see new highs in major U.S. equity markets. The S&P 500 gained 2.4% in the fourth quarter after closing 2025 at 6,845.50, marking a roughly 16% gain for the year. The Dow Jones Industrial Average closed the quarter up 4.5%, ending at 48,063.29 and up approximately 13% for the year. During the fourth quarter, inflation continued to show incremental signs of easing while economic growth remained resilient, contributing to an environment often described as the Goldilocks scenario. This balance of moderated inflation and steady growth helped maintain investor confidence throughout the quarter. The November core CPI, which does not include food and energy prices, was cooler than anticipated by analysts, increasing 2.6% over 12 months. Interest rates were lowered twice during the quarter for a total of 50 basis points in the fourth quarter, ending at 3.5 to 3.75%. Including the September rate cut, 2025 brought a total of three consecutive rate cuts. The Federal Open Market Committee ended the year forecasting future rate cuts in 2026. However, they indicated they could come at a slower pace than we experienced in the last half of 2025. And indeed, yesterday they met and kept rates steady at 3.5 to 3.75%. They are not lowering or increasing them at this point. And the future, they're just waiting to see more data on unemployment, the labor markets, and inflation. The fourth quarter of 2025 was relatively calm for the U.S. bond market. As the quarter ended, the 10-year Treasury yielded 4.18%, the 5-year Treasury was 3.7%, and the 30-year Treasury yielded 4.84%. Bond behavior continues to hinge on the direction of interest rates. Should the Fed pursue additional rate cuts, existing bonds could appreciate in value. Conversely, expectations of slower easing or persistent inflation pressures could push yields higher. Bonds can be an integral part of a well-diversified portfolio and usually offer stability during times of market decline. However, please remember, while diversification in your portfolio can help you pursue your goals, it does not ensure a profit or guarantee against loss. Safety comes with a cost, and many major banks are still only offering lower interest rates to savers. According to Barron's, the average bank money market rate on December 29, 2025 was 0.452%, and the average 12-month CD rate was 1.90%. We've worked with many of you already. We can, in the brokerage accounts, we can get much better rates. We can shop these different CDs with these different banks, and we get much better rates than this. If you're interested, please contact us if we haven't already helped you on this. Looking towards 2026, most strategists expect the bull market to continue. Analysts are optimistic about 26 with a consensus that year-end returns will be positive. However, investors are aware that market pullbacks occur on average every 18 months, so we must remain prepared. 2026 is also a midterm election year, and this has historically created increased uncertainty as investors assess potential changes in congressional control and their implication for taxes, spending, and regulation. While investors are optimistic, market volatility is likely to persist. This makes discipline and perspective essential. If 2025 taught us anything, it's that during the challenging times, it's best to avoid emotional decisions. Although history is not a forecast of future outcomes, in 2025, the equity markets had a huge downturn in the first half of the year, but by year end, they rewarded investors who demonstrated patience and discipline during the tough times. We want to remind listeners that we encourage long-term investing. If you examine a 45-year chart of equity returns, we are once again reminded that over a 40, 30, or 20-year time frame, even with some very severe downturns, historically long-term investors have been rewarded. So in summary, equities continued to reach record highs in the fourth quarter. The rally was primarily fueled by additional monetary policy easing, the AI boom, a resilient labor market, and consistently strong corporate earnings. In the fourth quarter, the Fed reduced the federal funds rate twice by a total of 50 basis points, finished the year at a range of 3.5 to 3.75, with the potential for additional but slower cuts next year. And as we know, again, they did not lower rates yesterday for January's meeting. Inflation numbers came in better than expected, and the consumer price index rose less than expected. So we enter 2026 with optimism, but we always need to be prepared for a pullback. Overall, investor sentiment was healthy and upbeat in the fourth quarter. In conclusion, while we are optimistic, we will continue to monitor potential disruptors, including a slowing economy, the effects of new tax legislation, the path of inflation and interest rates, and heightened geopolitical uncertainty. Focusing on your long-term goals and staying the course of a well-guided plan can help you stay grounded and confident during these times of uncertainty. We are here for you. Please reach out with any questions or concern. Your financial well-being is always our priority. As your financial stewards, we closely monitor areas that we believe are important to your financial well-being. We will keep you updated on developments that could impact your personal situation. Once again, thank you for your trust in us. One of our main objectives is to keep our clients informed, and we appreciate you taking the time to watch this update. Please feel comfortable sharing this update with anyone else you think can benefit from it. Have a super day.